Good day, everybody. This is David Friedman with my co host Dave Berkus on TCA Crossroads, where entrepreneurs and investors connect. Today, we have a very special presentation. This is one where I can sit back and just enjoy listening to Dave Berkus, who's going to do a mind dump on a presentation that was developed by Silicon Valley Bank called The State of the Market. And without further ado, Dave, how are you doing? And you can do your introduction, and I'm just going to enjoy it.
Okay, I'll take over. And first of all, David, thank you very much. And to the viewing audience, we have a lot of data for you, but boy, it's really important. This is the early part of the year. So there are a couple of things to do. The first of all is to look at the difference between early stage, late stage returns going back some period of time. This is not from Silicon Valley Bank. This is from PitchBook. And then I'll go to Silicon Valley Bank. So here we go. From PitchBook, the private capital indexes annualized returns for 1 year, 5 year, 10 year, and 15 year. Look at the differences and the expectations. First of all, venture capital, which we used to think was 23%, that's why we all thought we had invested in VC deals. Look how small the 1 year returns are, 3.6%. The 5 year, 12.5, 10 year to 11.9. None of this is 23%. So venture capital is challenged, and that's why so many of those went out of business. Real estate, which we thought was the most secure investment of all, turns out that this last year, funds that invested in real estate didn't do very well, 0.2%. 5 years, only 7%. Are you really surprised? I am. And then there are a lot of other types as well. Going up to private equity, which is a very late stage investor, those with a lot of money, funds, giant funds, and they expect to make a lot of money, and in fact they do. What they do is they buy the majority of companies, if not entire companies. They flip them in 3 years to 4 years, and they're making 11%. Last year they made an average of 17, 15, and 15. So we're not involved with that. We are very early stage. And although this chart doesn't show the very early stage, Silicon Valley Bank does. So we're going to switch now to the Silicon Valley Bank report and see what we can find from this data, which just came out. Is the state of the markets. They'll call it the first half of 21-25. I'm going to move through these slides as fast as I possibly can, and we're going to see what we know. Here are the takeaways, and you have to look at these very carefully because the type is a little bit smaller. But it's obvious that AI is driving the next wave of growth. We know that. One of the things that we should talk about is, as angel investors, we want to get in cheap and low. It'll take longer for us to get out, but our returns, if you look at the multiples, will be much higher than you just saw. And in fact, we can average 23%, but we got to wait an average of 7 to 11 years, longer than those that you saw from that last chart. But we were investing in AI from the beginning, early, and 2022 was when we first began to hear about OpenAI. Some of us were in AI much earlier. Many of us piled into early AI startups, knowing that in AI, 75% of them will be by the wayside in 3 or 4 years, not the 50% that we ordinarily see. Second thing out of this one, large funds dominate. We know that. Third thing is demand for venture outpaces the supply. The fourth thing is companies are raising VC have controlled their burn, which means VC funds aren't providing as much money as you expected and they expected. And number 5, a growing number of VC-backed companies are running out of runway. Number 6, VC fund life cycles have extended. It's taking longer than what they thought. Their usual thought was they could get out in 4 to 7 years. They're being trapped like we are with longer times. Most unicorns are stuck in a stable without having the time or ability to get on the track, meaning the IPOs. And then finally, M&A remains scarce and necessarily reserved for the most troubled companies. That's wrong. So let's delve into these. Have I gotten your attention? I think I need to. So let's go on to the next slide, slide 5, which is important. And remember, we're skipping around. And this is kind of a perspective on the innovation economy. First, a lesson from past cycles. Many VCs want to do it for crypto. That was 2020. That is so old. The VCs are out of crypto right now because, unfortunately, by 2022, plans for the decentralized financial return systems were shaken when the crypto industry collapsed. And the crypto industry partially has come back, but wait a minute, we can count the number of cryptos that have come back on one hand. And in 2020, when we loved it and invested in everything, we invested in any one of 1,000 or 2,000 different cryptos. Nobody knew which one would happen, just like we did in 1998 and 9, when those of us who were around doing this invested in anything internet. Does that remind you of anything? Today, it's the people investing in anything AI. There are over 3,000 companies that are specializing in AI tools. There are going to be only 20 of those in 3 years. And those magnificent 7 are going to buy them up, some of them, and incorporate them in their systems. And some of us will make money doing that, and it'll happen fast. But most of us will lose money on AI. I hate to say it, but that's what's going to happen. Go to the next box, a high bar for IPO. I'm not going to spend much time on reading this because it's kind of obvious to all of us. Only 5 IPOs in 2023 and 8 IPOs, I think it was, in 2024. When it said that the horses are in the stable and unable to get on the track, that's what it meant. And a healthy secondary market, that is where a lot of us are making our money. In the secondaries, it turns out that those companies that got public are finding a lot of money available to them. So the outlook for 2025, VC fundraising, look at the chart. U.S. fundraising, if we look at 2024, was less than the expected or the 2023, which are the dotted lines before it. So therefore, if the fundraising was less, what will it look like in 2025 according to SVB? Well, since we outperformed 2024, it looks like there's a lot of money to be raised. And the lineup of the funds that are looking for money is unbelievable. 64% of the funds are fundraising. That's not a good sign. And so therefore, I think fundraising is going to be a problem in 2025 as well. Hadn't expected that originally at all. Here we are in the early stage. So what does it look like for the early stage? The outflows were 1,370 companies that got early stage investments, and 1,500 were the year before. David, look at the early stage. Looks like Series A tech deals are underperforming our expectation, hitting the lowest level since 2012. So underperformance means we have to pick better deals. The fact that we are a group, the TCA fund, and the intelligence of the group is almost always better than the intelligence of individuals. If we're underperforming, we have to pick better deals. And that is the lesson to learn. The late stage, well, they're doing pretty well. 2024 outlook was pretty good. 2025 outlook for late stage is even better. But we're not in the late stage. So late stage takes a lot of money, big giant funds, as we talked about a minute ago. Go to the fourth one, exits. U.S. VC-backed tech VCCs. It turns out that the number of exits for the big funds is not what people thought. Only 7 were actually exited, giant private equity exits, and 20, half of what they expected. So what is the outlook? Turns out we jumped the gun in 2024, and the outlook for 2025 is a little better because there's a lot of money on the sidelines. So exits should increase in 2025. All right. 2024's outlook was 15. And so we jump to slide 10, a tale of two consumers. And what do we mean by that? Turns out that what we mean is there are the consumers that are the those that have a lot of money and those that don't. So let's look at the difference. There's a giant difference. First of all, the softer job market is what we think is a wild card for 2025. If you look at the unemployment rates and the difficulty in finding jobs, it turns out, again, remember, a tale of two consumers. Those that are the more wealthy ones, the college-trained consumer is the one at the upper side that has the higher percentage of jobs with the expectation of the time that we had a recession. And those that were not college trained are still having a problem finding the jobs. Unemployment is higher with a non-college trained consumer. The white collar jobs are harder to find. And if you look at all of them trending lower, there are fewer white collar jobs. You saw during 2024 that lots of people were being laid off at companies that in 2022 and 3 were hiring as if it was the beginning of a great economy. If you're to send your kid to college today to learn to program with AI now doing no code, at the end of his 4 years or her 4 years, you'll find that that person isn't going to find the $300,000 job that everybody dreamed, or even the $120,000 job that was the norm in 2022. Look at the lower left-hand side. Consumer spending also bifurcates by income. Those that have higher income spend more. That's obvious, but look at the numbers. You can see that that's really true. And finally, consumer health shows cracks, meaning college education also provides for better consumer health over time. And there's something that I think we have as a lesson to learn from that. All right, let's jump to slide number 11. America's got overseas talent. What could that possibly mean? Well, tech layoffs show hiring is still dormant in 2025. That is a shock because we had hoped that the release of money that's been on the sidelines would do the job of allowing us to hire a lot more people. We are letting out air and an awful lot of salaries, which means our expectations are going to be lower than they were when they might have been at the time when we all entered college, or those who entered college 9 years ago. So there are a lot of things coming from overseas, lower left-hand side. It turns out that places like Bangladesh are getting lots of our jobs. And then you'll find other countries too, like Singapore, surprise. India, which got most of our jobs, don't get as many now because, you can guess, the labor rate has increased. So where do those jobs go? They go to people who are being trained or self-trained in third world countries and charging very cheap rates. It makes sense to me But boy, it's a trend that SVB shows by percentage and something we should all pay a little attention to. All right, let's look at funds. Here comes the fundraising for VCs. Another surprise. All right, so the 90-10 rule is the way the venture capitalists have to work. And the 90-10 rule basically says that big funds expand, they get their share, little funds are getting tiny little bits. They're not raising as much, they are not able to spend as much, and they're not making as much. So look at the lower left-hand side. That diagram shows that big funds are getting bigger, and the little funds in the red are in trouble. And the largest managers are the ones getting the concentration. No surprise to those of us that have seen this kind of thing happen, or those of us trying to get into the bigger funds. Not speaking of angel yet, we'll get to that. And look at the lower right. The top firms raise 1 in 5 VC dollars. And so the top firms, which means only the top 10, are raising 20% of all the dollars, which means the bottom 90% of funds have to scramble for the other half of the dollars that are being spent. These trends are surprises to all of us because we thought that 2025 was going to make it really, really easy for all of us. All right, let's go to 14. Scaling is hard. The growth rate is going to be a challenge for all of us, for the funds that we're in. I showed how low the growth rate was. If we look at Series A, that's what we are, we're going to have a reasonable growth rate, but our pre-money valuations in early stage investing is coming up at a $10 million number. And that's not a number we like to see. I usually like to lecture people that we make our money going in, and yet we're paying money going in at a higher rate. Not necessarily good, but it could lead to underperformance, which is what I've been saying all this time, making money going in, higher performance coming out. And so learn from this that it isn't safe for angels to invest at a high pre-money valuation, even if you look at something that looks good, unless this is at a later stage, and we're not really later stage investors. So if we go to slide number 15, the new rule of thumb is the larger funds, if we look at the top in green, are taking a longer time to get their money out. If we go back to the earlier years, 2011 and 12, it took a shorter time. And now you're going to find the average has decreased because in the last couple of years, these funds, the large funds, not the angel funds, are taking the same amount of time as the angel funds to get their really high returns. Shock? Sure is. And then it's an increasing amount of time between funds in number of months. So the numbers in blue are the number of months between each one of the companies raising funds, and it's taking longer for them to do so than it did before. 16 says, when VC dims, incubators shine. And if we look at that, this isn't angel investing, this is incubator investing. And there are 4 or 5 major incubators. We often get our deals as angels from incubators. Why? Because they're having their moment in the sun at this particular time. The number of incubators as their share of VC deals, look at the green versus the blue right below it in the upper left-hand chart. The incubators are green, increasing dramatically, lots more deals. The VC deals going down. It's hard to see the difference, but the blue is way low. Go to the right-hand side, which is the various charts, and you're going to find that accelerators have a big impact in the small hubs. I've been saying for years that flyover states are where the money is. And we as investors in the angel community are now investing in flyover states for the first time, maybe ever, with our syndication. And if you look at the green is where it's at. That's where the money is being made today. Because why? Here we go again. The valuations are lower going in and their expectations are less. Therefore, we make more money going in. How many times have I said that, David? Incubators or incubated startups and accelerator valuations are higher than those that were not incubated or at least coached by reasonable groups like TCA Fund. Econ 101, supply and demand. If we have too much supply, we're not going to get much in the way of return. So what does that mean? Multiples are declining. And if you look at the upper right-hand chart, again by year, and in this case, quarter of a year, the problem in the last couple of years with venture especially has been far too much supply, far too little demand, far too little IPOs. And the bottom line was the venture community got spanked. The lower left hand, the value creation has slowed. Lower right, multiples across stages are down. This is not good news, but it has to be said. Let's go to slide 19. The VC is in the era of AI. Are you surprised? No, nobody is. And so we can talk about the investments and the pace of return for VC highs. When will it happen? That's the question. Because if we invest in AI, will it be a shorter return or a longer return? The prediction in the upper right is 48% of VCs are going to increase again, but not as high as it did in the glory days of 2001 and 2022. And the increase will come because AI, those that are good and those that are going to be purchased by the Magnificent Seven, will increase in the valuation, not in the number of companies. I said a while ago, we'll have a massive fall off in the number of companies. Look in the lower left, the tale of two recoveries. All right, let's jump to slide 21. It is an arms race that's propelling the VC industry, at least. They are looking at frontier tech, designed, just like we've always said, as 3 to 5 years before the other industries or the other investors, like public investors, really recognize the value in these companies. David always says that the hockey player follows where the puck is going, right, David?
Mm-hmm.
And here's a good example of it. Frontier Tech is rising in the ranks. And you can see the chart that shows it in the upper left. For later stage companies, it's an AI or bust. So AI really means a lot right now for Frontier Tech. And the investors in Frontier Tech are spending their time with AI. Lower left dominates not only that, but also enterprise investments. So for a while, AI is doing what in 2000 the internet did. In 2008, the recovery for the financials did. In 2020, the crypto industry did. And now it's the AI industry. And be a little careful because this is a bubble. Can you begin to see that that is the trend? Slide 22. David, it turns out that tech comes to the defense. And if we look at geopolitical concerns, they are top of mind for these execs. So at tech, VCs follow it with, what can you guess? Defense and other kinds of things, such as worrying about people who are attacking their sites, so therefore it's defense of their sites. Or if I look at defense in the geopolitical sense, they are investing in defense companies. So look at the lower left. Defense tech and unicorns are taking flight. That will tell us a lot. We haven't done much investing in defense tech because sometimes it takes a lot more money, but that's where the money is going. And then if you look at the defense industry, capital requirements are higher, which once again tell you why sometimes that's something for the VCs and the private equity companies, and not the early stage companies or groups like we are. Slide 26. Less gradual and more graduating. What this means is seed to Series A grad rates are still muted, as this backlog we keep talking about of seed extensions takes time to digest. Far too many seed companies, far too little money going into them. All of the funds have invested less money than they did during the heyday of 2021 and 22. It is harder for the seed companies to make to receive investments, and that's why the money right now is kind of on the sidelines as we're looking for more of these seed companies to come and be available to us. All right, slide number 27. The yellow brick road to profitability. Tech companies are closer to profitability, especially the largest tech companies. Now, there's the kind of good news. If we look at the years, and the years in this case are the colors from left to right, the recent years are showing, if you look at the darkest line in each of the sizes of companies, the profitability for $1 million companies are coming up. The next one is the $2 million or $2.5 million companies, the same, go all the way to the right. You can see that even the $100 million companies are getting to profitability faster than they did before. And yet, what is profitability? Look at the lower left. The growth rate is lower than ever. So they can get to profitability, but the growth rate is taking longer, and it is less. Slide 29. The cash runway continues to fall at early stage and across all sectors. That's not necessarily good for the companies looking for the early stage. So we should say that the cash, as we've said before, is not as available as we thought it was going to be. And the sectors change, of course. We've talked about AI, robotics, and some of the other sectors being good. And the revenue expectations are lower than they were during the heavy days, except for just a few of those sectors. And those sectors are going to suck away a lot of the money, such as, again, robotics and AI. All right, let's go way to slide 31. Slide 31. The companies are not all right. If we look at the uptick in troubled companies, it's obvious that there are more of them now than there were during the past. In the heyday, this is by quarter now, in the heyday they were low. If we look at the last couple of quarters, the troubled companies are declining, which is good news, but they are higher than the average. That's the line that's going from lower left to upper right. More companies in the upper right chart, more companies wind down, and fewer are being acquired. Not necessarily the news we wanted to hear. Go to the left, the lower left. In Silicon Valley, bankruptcies are on the rise. Oh boy. And go to the lower right. Is that something that is more to come? Turns out that Silicon Valley Bank believes that there are more bankruptcies that will come. This is not something that is decreasing. Slide 32. Putting old unicorns out to pasture. Oh, what does this mean? Well, it means that the unicorns that we all celebrated are not getting to their IPOs. Many of them are being purchased by other unicorns, large funds, or just being put out to pasture, which means their valuations are decreasing. Lower left-hand side, unicorns are skewing to being older. When they first began to be noticed way back when, they were jumping into public IPOs really fast. And now the number of years, the longer it takes, if they even get to IPO, are showing, as you see from the first lower left-hand slide, to be dramatically lower than we thought they were going to be. And that's why on the lower right-hand side, unicorns worth more than the IPOs since 2010. Lower right-hand side, unicorns are worth more than the IPOs, which means that once they go IPO, they actually lose value. Is one of the reasons why unicorns like to, in this case, stay private. Is not something we ever expected to see. One more slide kind of sums this up for us. And that should be the slide number 35. SOS, startups hit the distress signal. Now we're back to our line, David. Startups exhausting the runway. Look at this one. If we look at the year 2022, the startups got lots of runway. If we look at it today, the startups are losing their opportunity for runway, which means they don't have as much cash. And that's one of the things they have to continue to live. So we have to be very careful that we invest in companies we're willing to sometimes put secondaries into to keep their runways longer. Their fundamentals on the upper right-hand chart are worse at the time of purchase than they had been before, which means that the companies buying them are not paying as much, and the fundamentals, which means the profitability, lower than before. So that leads to the lower left-hand chart. Growth falls sharply, leaving it up to M&A, not IPOs. Lower right-hand side, nobody wants to show their hand. This is one that I've been lecturing in for a while. People who are trying funds that are trying to value these startups, let alone the big companies, and their valuations. GAAP requires that you value to market, not to the last deal. And so the valuations as the funds are showing them, I believe, are overvalued, and this chart shows they're overvalued. Nobody wants to show their hand. They don't want to show what the real value of these companies might be. That's what that lower chart is. So, David, I'm going to just sum this up by saying it is a mixed market. It isn't yet at the first half, at least according to Silicon Valley Bank, where we thought it would be because of several things. Number one, we thought that we would have a very quick recovery by lowering the interest rates by the Fed, and the Fed did not do that. Number two, we thought that the money that was on the sidelines would flow dramatically for 2025. SVB and we don't think that's happening. And that's not a good sign. And number three, we thought the profitability of these companies we invested in would be higher faster. And that's what's not happening. And number four, we thought that we'd be able to get faster exits because of all of this activity. And that is not happening. Those are the summaries of what I got out of this report, long as it is. And I hope that we've taught a little lesson to all of us. We should invest carefully, and that's why we, meaning a TCA fund, have experts within our group, the Tech Coast Angels or the TCA fund, and why we use the visibility and the intelligence of crowds, because always we have members who know industries that we invest in to help us to make our decision, because we have a difficult road to follow during 2025. We are prepared to follow it, and it's something that will reward those that do have that ability. David, I've thrown things at you. Any comments you have with this overabundance of information?
Yeah, I'll just sum up what I heard. First of all, it's very interesting to me because, Silicon Valley Bank has a broader perspective looking downstream in the VC market, the company's later stage than we do at TCA. But it's very clear that AI has become really dominant, not only AI from the perspective of pure AI technology, data centers, cybersecurity. So, but the point is, technology is still a very key aspect of our growth and our innovation. It was interesting to see the transition from India, which has been traditional, Ireland for doing, and Estonia, into Bangladesh and into Pakistan and other Southeast Asian entities where technology is cheaper, which I thought was pretty interesting. The other interesting components of the talk, big funds are still doing better. The bigger get more deals because the entrepreneur says, well, if you're bigger, I want to get I want to go out one time versus having little investors invest and screw up my cap table and make it messy. The fundamental point that you raise in Silicon Valley it's tougher to make money today. Valuations are higher. And because the demand is chasing the supply out there. However, if you do get involved early on with the accelerators and incubators, as you point out, it is very clear that there are lots of opportunities, but you have to be able to, in a sense, kiss a lot of frogs to get to that, the prince or princess. You're seeing a lot of growth. A lot of people are getting into the entrepreneurial world. But from the perspective of angel investors, early stage investors, you have to do your homework. You have to do your due diligence. You have to look at the deals from a variety of perspectives. You can't just, take a swag because it is harder. More companies are failing, but there are deals out there. We see them in TCA. We see them in other entities. You just have to do a lot of digging. You have to be able to focus, ask the right questions, and flip it around to the entrepreneur side of my last comment. The entrepreneur really has to come up with a good valuation. You can't just wing it and say we're worth $10 million in a pre-money, pre-money valuation with zero revenue base. You have to be more realistic because the angel groups are looking for a value, and we're looking for that elusive 10x return, which is harder. But the point is, the entrepreneur has to be able to have a very good leadership team. We heard this before with several of our guests. You have to be able to differentiate and have sustainable differentiation. And you really need to be able to tell the good story of why this is not only a good business, but an investable business. And that's the last comment that I'll make. I thought it was great. I thought a lot of information, made me think a lot. Still probably think a lot after we end this presentation. So I'll let you have the last words and sign off for all of us.
All right. Well, David, you summed it up very nicely. A lot of information for people to absorb. And we hope that you got something out of this, everybody. We'll be doing this occasionally. We get these reports before anybody else sees them. We analyze them, and we hope that we give you a summary of them because it's overwhelming. And so thank you for spending your time with us. And then we hope that this value added really was something for you.